Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. Hope everybody is doing well. Looking forward to the non-farm payroll print on Friday, and in this workshop, I'll be getting us ready for it.
Just on the ag/geopolitical front, just posting a headline via Reuters.
Just checking this headline.
Turkey Foreign Minister.
Yeah, just looking for any oil news for OPEC, so just keeping my ears out open for that. Okay, folks, just as different folks are signing in to the workshop, I hope everybody's well. Good to see some good faces here. Gabriel, Suneth, Alexa. I've got a very interesting session today. And remember, the usual disclaimer before each workshop and webinar is that this isn't a signal trading service. I'm not offering trading advice. You're just looking over my shoulder, seeing how I'm approaching the market, and it's not a signal trading service or anything like that. Preview and trade plan for Friday's non-farm payroll. This is going to be a big event, and whenever we're looking at upcoming data points, not all upcoming data points are the same, and we have a particular focus on US labor data at the moment because of its impact on inflation. So if you just have a look at this, let me just move this away. Let me bring this over from my other screen. Let me first of all just show you how labor data is inflationary. Now, this is called something called the Phillips curve. And basically, it outlines the basic relationship between the labor market and inflation. Now, the first thing to say is this curve isn't always as perfect as it seems here on the chart. It's an economical model. And it's theoretical, it's not always true, but nevertheless, it's very helpful in the current market environment because this is the influence that the Fed recognizes and will be responding to their interest rate moves in accordance with what's happening here in the labor market. Very basically, when you have a high unemployment rate, in other words, when lots of people are out of work and the labor market is poor, that's deflationary. Why? Because employers say, well, look, lots of people need a job, so we can offer lower wages because there's more competition for our jobs, and lower wages mean there's less money supply in the economy, and so inflation falls down as prices fall. On the other hand, when unemployment rate is very low, in other words, lots of people are in work and the job market's strong, which it has been strong in many nations, and there's a number of different reasons for that. Sort of quite a few people took early retirement over COVID, and so there's a general strength in the labor market. Unemployment rate in Australia, for instance, I think is like a sort of 30 or 40 plus year low. And it's very low in the US, I think about 3.6%, something like that. So it's pretty low. And that is inflationary. Why? Because employees can demand higher wages because there's less competition for jobs. So, if you've only got a few people qualified for the job, they can demand higher wages, and there's competition amongst employers to get them. So that's inflationary. So the first thing to understand is the US labor market is important because what do the Fed want to see? They want to see the unemployment rate rising. Now, let me just show you here. Right now, where are we? If you just take a look at this. Look at this. So this is what's expected from the Federal Reserve when they meet on July the 26th. Markets are saying there's an 83% chance that they hike by 25 basis points, right? The latest dot plot from the Fed has indicated exactly what the Fed think about upcoming interest rate hikes. They clearly see 2 rate hikes still to come, and that's what the Fed's dot plot has shown. Now, short-term interest rate markets see 1 interest rate hike to come, and then 1 and a little bit. So they see it going to 5.37, but you see the terminal rate here is at 5.41. So short-term interest rate markets say there's 1, the Fed's dot plot say 2, right? So what that means is when we have the labor data out this Friday, this will influence market expectations. And if the labor market is really strong, then that will mean the Fed has to do more to tackle inflation, because, you know, if the labor market's strong, inflation is pressured to the upside, so the Fed is more likely to have to hike interest rates. If it's poor, then they're less likely to have to hike interest rates. So that's the way the Fed is seeing the labor data due out on Friday. So once you've got that relationship clear, now you can see why Friday's data is going to be so influential. Now, the opportunity that I'm personally looking for is an opportunity to go long gold or silver. And the best opportunity will come from a miss in the US labor data. So let me just get rid of the countries. You're going to focus on the labor data. And this is what I want to see. So be careful to take note of this. I want to see hourly earnings coming out 4.2% or lower. I want to see the headline coming in at 110,000 or lower. So if you look at the prior headline, you see that prior headline was 239, and that was revised up from 190. It's now expected to fall down to 210, which is the lowest reading that we've had, you know, on this chart since June 2022. So it's already expected to fall down to 210. But if it goes into 110, that's what I want to see, because that will give a good indication that the labor market is weakening and that the Fed's interest rate hikes are starting to impact. Now, also, if you take a look at the unemployment rate, you can see that that has moved higher to 3.7%. Now, if you look at it historically, you can see still very low levels, which is obviously, a good thing for individuals. And employment rate, if the unemployment rate goes higher, that's what the Federal Reserve wants to see. So if the unemployment rate comes in above 3.8%, so ideally, if that comes in at 3.9%, and the headline comes in 110,000 or lower, and the hourly earnings comes in 4.2% or lower, and watch out for revisions. Ideally, if the priors are revised lower and unemployment potentially revised higher, that would all give the clearest tradable opportunity that I can see. Because in that situation, what I would then expect to see is the dollar to fall lower, yields to fall lower, and that's a natural boost for gold or silver. So, looking at gold and silver, you can see that silver is trying to form a bit of an Harami inside bar there. So I'll expect that to break higher, and I could put my stops just underneath 21.25, looking for a run higher there in silver. In gold, if we got the print as I've outlined, then I'd use this potential trend line to go long. So if I go with it, stay above, stay with, stay long. And if it breaks lower, I might just put my stops underneath that 1900 region, which is also the 200 exponential moving average on the daily chart. So very, very clear, defined level here. So as long as we stay above this, I'd stay with the trade in the instance that I've outlined. Okay. Now, there is something else to add to this. You can see, look, when you have the US labor report over the last 10 years, gold tends to gain out of the report. So there's a seasonal bias for gold to gain out of the report. And over the last 10 years, in the 4 days after the report, 60% of the time gold's been higher for an average return of 0.47%. So gold has a bias to gain out of the US labor market report. And on top of that, if you just take a look at gold seasonals, you can see that seasonally over the last 15 years, right, you can see that gold tends to gain during July and August a 60% bias to the upside. So gold has a seasonal pattern of bias long and has a strength out of the US labor market report. So all of that means if I get a miss in this labor market report, that's an ideal opportunity to go long from a swing trading perspective. and a intraday perspective. That's the way that I'm seeing it. Now, of course, it's not trading advice or anything like that. I'm just saying that's how I'm looking to trade it. And of course, you've got to always manage risk. And where I've been managing my risk on gold will be sub 1900 or just above that trend line. And then I will be looking at silver as well, with stops just underneath that sort of 21 region, which is this nice ascending upline there. I definitely would expect that to hold. So that is my bias for Friday. Now, intraday, I would also see an opportunity to short gold. When would you see that opportunity? If I see average hourly earnings coming above 4.3%, so 4.4% of the hourly earnings. If I see the headline coming in above 275,000, and if I see unemployment coming in 3.4% or lower. So unemployment 3.4% lower, this above 275,000, that above 4.4%, then I would expect to see downside in gold. Why? You'd expect yields to move, you'd expect the dollar to move higher. But what I would say is it's not as good an opportunity as a miss, because markets have already been pricing in, quite a lot of that sentiment. Okay, so short-term interest rate markets have been moving higher. The Fed has confirmed they're expecting 2 more rate hikes this year. So that's the kind of expectation that we have. So if we get a strong jobs market, all that's doing is sort of telling us what we already know. And Powell also indicated at the last rate meeting that he could see a scenario where the labour market stays sort of strong, even as they fight inflation and win the battle against inflation. So in other words, labour data, although it's inflationary, the Fed aren't looking at it and saying, okay, this is the #1 inflation story, what's going on with labour data. Instead, they're saying, well, the labour market may not behave in the way that we're anticipating, and inflation still come down. So then that means that the inflation data next week, I think it's on the 12th, on the 12th of July, that will be important. And it's exactly the same outlook. And I will cover that live next week. Okay, 1:30. We'll look at that live, and we'll cover it on the Monday webinar as well. It's a very similar outlook to the outlook I've got today on gold with the US labor market. So just to summarize, making sure everyone's clear, if you've got a question, please ask it now, because this is all the information that you need. If the labour market is strong, I'd expect that to increase the expectations for higher rates, dollar higher, yields higher, gold lower. If, on the other hand, I see a big miss in the data, as I've outlined, then I would expect to see the dollar lower, yields lower, gold higher. That, my friends, is the outlook. Short, sweet, but to the point. Best trading opportunity of the week, without a shadow of a doubt, on this non-farm payroll. I've been waiting for this one all week for gold and or silver. One last thing to say is just, if you're trading gold or silver, you do need to know about this. It's called the gold-silver ratio. Gold, silver ratio. Right, so when the gold-silver ratio moves higher, what it does is it's showing you that gold is more expensive relative to silver. So when this ratio is high, it means that silver's cheap. Okay, so if you look at this, and if I just overlay silver onto this chart, what you'll see is when the gold-silver ratio is high, that's not right. That is not right. That's bizarre. Try one more time, and that's not behaving the way it should do. There, that's better. So when this ratio is, no, this is not working as it should. Something's wrong here. I can't quite work out what it is. Let me just see what this is here. No, okay. Something's wrong with the scaling and I can't quite work it out. What I'll do is I'll show you instead. This is if you look at this article, I explain how to use the gold-silver ratio. And basically what you want to look at is when the gold-silver ratio is high, it means that silver is cheaper relative to gold. Okay, so when you get that, when you see the gold-silver ratio rising, what it means is that silver is cheaper relative to gold. So in other words, a high gold-silver ratio can mean that silver offers good value for buyers. So just keep an eye on that gold-silver ratio. It's definitely worth being aware of. It's not particularly high at the moment, but it is sort of heading up towards those sort of higher levels. You know, that can really boost, help boost silver, and particularly if we get a big miss in the non-farm payroll data. Okay, folks, good to have you here. Don't forget, I will be returning on Monday. Got some interesting data points to get ready for. Got that CPI inflation print, and we've got the Reserve Bank of New Zealand meeting as well on Tuesday, early Wednesday or late Tuesday. Got the RBNZ interest rate meeting as well, so I'll be covering that and getting us ready for it, as well as the University of Michigan Consumer Sentiment print. Okay, folks, take care, and I hope you all have a very good rest of your session. Thank you all very much for attending, and I'll speak to you on Monday. Thanks, everyone. Now, take care now. Goodbye.